professionals, and our ability to win new contracts. Changes in technology, availability of financing, our ability to successfully compete and integrate our expansion plans, liabilities, political instability, and general economic conditions affecting our industry. Unless otherwise indicated, the information contained herein is preliminary, indicative, and is based on the management information, current plans, and estimates. Thank you. I now hand the conference over to Mr. Srikanth Chakrilam. Over to you, sir.
Thank you, Schneider. Good evening, everyone. Thanks for joining the Q1 earnings con call. Just to quickly summarize, the company has accelerated its revenue in the current quarter by about 13.4% to rupees 264.36 crores in comparison to the previous quarter. The revenue growth has gained momentum with a healthy run rate in June by rupees 92.54 crores, which is USD 12.5 million. And the company in this quarter has won 28 new clients, which includes Fortune 500,000 and Global 2000 clients. The notable factor here is we have two large clients with approximate total contract value of $14.1 million. And the company has invested in additional manpower in line with its business transformation initiatives and commencement of outcome-based contracts, which has partly subdued the EBITDA. New hires made for execution of this outcome-based project and deployed in knowledge transfer has resulted in reduction of EBITDA of about 1.5%. The two large clients client additions has also mandated us to hire laterally, and there is a slight delay in billing, which has had an impact on the utilization. But this is, of course, a temporary aspect of the business. We have also made hires for centers of excellence, and expenditure incurred for marketing in line with these business transformation initiatives has also resulted in a reduction of EBITDA by about 1%. But all the new offerings that the company is making are all at higher rates than the existing business, and this will subsequently improve our margins. Other factors that also had an impact on EBITDA are salary revision and replacement of resources. This has been an unanticipated challenge in this quarter, not just for us, but for the entire IT industry. It has been a burning issue. The demand for some of the employees are at unprecedented levels. But again, we believe this is temporary because it is not really sustainable. This has had an impact on the EBITDA. But with some of the measures that we are taking, we are hopeful that we will come out of this situation soon. Some of the measures that we are taking are improving the bottom of the pyramid hiring. We're attracting some of our former employees to alumni connects, and we're also tying employees to long-term innovation outcomes, along with offering attractive compensation opportunities. So the final EBITDA for the June quarter is at rupees 24.3 crores, and the EBITDA margin stood at 9.2%. The company also expanded its footprint with opening offices in Singapore and Czech Republic, and representative offices in Mumbai and Chennai. This is all in line with the business plan, and we have had client wins in these regions, and some of the requirements are that we have offices in those areas, and based on that outcome, we have opened offices in these areas. We've also seen a revival in the travel, transport, and hospitality sector. We have seen travel and hospitality come back to not entirely the previous levels, but there's a vast improvement in the utilization in these areas. And I think this trend will continue in the upcoming quarters as well. Some of the initiatives that we have taken in the last few quarters have also started paying off, and we have seen revenues in the areas of RPA, cloud, and other digital areas. And we will consistently report the progress in the days to come. Overall, I think our planning and execution in terms of the bigger picture to become a digital assurance company is on track, and even in terms of short term for the year, we are on track to achieve the desired outcomes for the company. So at this point, I will have Christian take over for key financial updates, and then we will have the floor open for questions.
Yeah, thank you, Srikanth. Good afternoon, good evening, and gentlemen, if you have logged in from other countries, very good morning. The quarter has begun very well on robust sales numbers, but I think I will take you all back to the 2 quarters behind very clearly that considering the pandemic where we started and the kind of nature of the business what we are trying to do, I think we did revise the strategy. While there has been a couple strategy over the next 4 years to become a $500 million company, but I think the main strategy has been in terms of how do we really accelerate our offerings and try to supplement the revenue, sustain and float in the last year. So to this effect, in the last 2 quarters, the kind of investments what we have made and the investments what we have continued and spilled over in the current quarter is what is the effect which has seen in the EBITDA and PAT. While technical terms, probably the EBITDA is about 9.2% on a normal basis. I've given a breakup in terms of where we have really priced in. And the surprising element which has come through for us, which was necessitated for the business, is that winning a TCV on an outcome base for 2 of the contracts, which is necessitated to do a 120 people deployment of people on a knowledge transfer basis is what is necessitated in this cost. And we expect this to get evened out as it starts moving up, and we expect net to be very confident that one, on the investment front, that we have done front-loaded the marketing and sales reorganization for gearing up the company. The transformation initiative what we took over the last 2 quarters, I think is really paying dividends, and we are very confident with cost optimization and the kind of results what we are trying to look at it in terms of growth, in terms of revenue. I think we'll be neutralizing the entire set of costs and becoming net equal to uncomparable to previous year as we start moving up the quarters and end the year very positively. As it stands, basically the revenue in terms of dollar term is about 36 million, 36.04 comparing to 32 million, which is about close to 13.5-14%. The on-site offshore mix has been steady in terms of contribution from revenue mix of 51% and 49%, and the effort mix in terms of people is about 21 to 79. While it is so, I think it has put the new accounts to accelerate and ramp up has definitely put a bit of pressure invariably. We have gone for few of the hirings which has necessitated, one in terms of technology, one in terms of jumpstart projects to convert into an FTE, because which is again a continuous process. While doing that, I think the costs have really jacked up. We hired about close to 98 consultants, and also the preference of highly technically qualified people trying to operate as a consultant, they prefer on tax neutralization in terms of the overseas countries. So that is what in the other expenses, the major differences which is coming through about close to 7 crores is on account of that, and 2 crores on account of the marketing spend which was necessitated in terms of segregating hunting and farming. While it comes to the salary cost, I think we have given an average overall increase which we have done for 2 years at about close to 10.5% in the scheme of things which was necessitated. While we had planned and spanned it out over 6 months criteria, then we introduced a variable pay scheme across the company ranging from level 4 to level 8 employees in terms of getting into starting from 10% to 30% depending on the performance, so that we can price in a slight better increment in terms of retention, because the turnover stood at about close to 25%, while the industry average is there at about 22-23%. This was necessitated for us, and we know that this is an estimated cost, but I think instead of spreading through a couple of quarters, it got spilled over into the front-loading quarter. So we know for sure that this is going to get knocked out. The heartening point basically is that we were, because of our focus on the digital and transformation initiative and other technologies, I think the contribution came about 37-38% from that segment basically, and the 62% came from the normal quality segment, which has facilitated for me. While my because of the people front, my utilization and offshore has dropped to 76%, and on-site remained at about 95%. My realization in terms of offshore has moved up by about $1 to $22, and in offshore about close to $2.5 to about close to about $75+, which is a very heartening point. We have serviced in the Q1 about close to a number of active clients is about close to 233. The clients won, which is really good actually, is about close to 28 clients which we have won during the quarter. The last quarter has been notable at about 22 clients. The confidence with which the wider margins will move up is that the new clients have been coming up on newer areas and slightly at a higher margin, and with cost optimization and pyramid, as Srikanth suggested, I think we are very confident that we'll be able to pull this back. The sectors which contributed very clearly is that the retail and e-commerce continue to be our giant at about 26, 27, 28%, and we also have about 20 to 23% from BFSI, marginally moved up comparing to last year. And we see an uptick of about a percentage point in terms of travel, which is slightly showing trends. And we expect this sector to really bounce back, and that is where the composition in terms of where we stand really work through. We started the year basically in this quarter. Of course, we did complete the AGM as a part of the corporate governance on June 4th. On completion of the year, and distributed the maiden dividend, and with all the support of the shareholders and members. The cash flow generation on account of application of all the even though we have pressed the DSO to about 52 days, and the cash flow generation has become net neutral invariably because we have to apply on all these investment costs, which has not been carried out in the balance sheet as any kind of deferred expenditure. Which as 4 years back it was decided that it is not the policy of the company, and the company will be absorbing it in the year in which it has been done. And these two contracts necessitated the specific spending, especially to grab this from a competing SIs to really get through the TCVs. So with there, we are on a poised for a good wicket to really move on. I think on the year front, if it looks clearly, year to year, we are confident that will be on a comparable basis and will be going up on the top line, while the bottom line remains could be the same or slightly north of that in terms of what we have done at the PAT level. But we are very confident that we are moving in for a good growth and making all efforts to really stitch the business together. With these opening remarks, I leave the floor open to the members for asking questions, and we'll be more than happy to take field questions. Thank you.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on the touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Anyone who would like to ask a question, please press star and 1 at this time. Ladies and gentlemen, we will wait for a moment while the question queue assembles. The first question is from the line of Hasmukh Gala from Finvest Advisors LLP. Please go ahead.
Yeah. Can you hear me, sir?
Yeah, we can hear you.
We can hear you.
Yeah. Fine. Thank you. Yeah. Very interesting and frank discussion and opening remarks by our CEO and our CFO. Just would like to understand that what is basically now changing the very complexion of the IT industry. You said that you have got these outcome-based 2 contracts which are quite large. So, what does it entail in terms of the effort? Forget about the initial investment that you have made, because that will pay out during the course of the year. But say, for example, in future, as you get to the more and more these kind of contracts, what kind of revenue and margin trajectory we can expect? That is my first question. My second question is that apart from this increase in salaries and the operating expenses, marketing expenses, hiring of the consultants, etc., was there any other factor which did affect the margin, which has fallen down? Like we were expecting that in last year, FY21, we have made margin of about 17%, including other income, and we maintained that probably the margin will slightly go up. Now, my question is that in this current quarter, we have have the margin of only 9-10%, which implies that if we have to grow at about say 15-16%, although we have grown at 21% in Q1, we will have to earn 20% EBITDA margin in the remaining 3 quarters. So do you think it will be a tall order given the current situation, pandemic still continuing, the third wave fear, and more importantly, what you described about the employees? I do agree with you that I think all IT companies are facing the same issue. There is higher attrition and people are demanding very high salaries. So just give us an overview of what is likely to happen during the current year, and then how do we proceed to meet our target of 500 million in the next 4 years or 5 years? And what will be the margin profile you will be looking at? Because you said that these outcome-based contracts are basically having a higher margin than what you have been hitherto earning. So if you can give some clarification, it will definitely help us.
Sure, sir. Srikanth, you would like to talk about the outcome-based methodology? Then I can take up all the numbers front.
Sure. So, thank you. Thanks for the questions. First of all, in terms of guidance, I cannot give you any guidance, but I will just give an outlook. So, if you look at some of the numbers, just based on numbers, it may seem slightly out of context, but like we mentioned in some of the previous earnings calls, this year is a year of investment, and some of those investments have already started paying in terms of growth. But we have front-loaded all the investments. So, of course, there is an impact on margins in the short term, but it will definitely even out in the long term. And in the previous years and previous quarters, some of the revenue that we've been getting, the relations that we've been maintaining with clients is not at the highest level, and that is something that is changing for the company, that we are actively pursuing relationships at the highest level, and that will definitely have a positive impact both in terms of growth and revenue. And some of the time and material aspects of business where we have little control on margins is also changing with the outcome-based models. So we will be responsible for the entire delivery end-to-end for the clients, and that will give us a lot of control in terms of pricing, utilization, etc. And that is something that is changing for the company. And in terms of investments, I think whatever we want to invest, we are more or less done. So we've front-loaded all the investments, and I think we are in control of that. And I think the outcomes have also started paying. RPA, cloud assurance, and all that, we have started seeing revenue. And we have few more offerings that we are bringing out to the market, and all these will be at higher rates. So definitely, I think in the overall mix of things, we'll certainly see improvements in terms of margins.
Thank you, sir. Take up the numbers in terms of trying to talk to you in terms of the outcome-based model. The basic difference, continuing what Srikanth said, is that clearly is that we take the ownership in terms of the outcome-based model, which means that I have confidence in my business and technology, what I deliver to the client, and I go to the client and say very clearly that I reduce your cost by 20% and increase your throughput by another 30%. I mean, just giving it as an example, and that is what is becoming the industry trend today, is that even we as a service recipient at some point of time, whether in daily part of life, we try to look at what is the differentiation which somebody can bring it to the table. So we are trying to do that basically to the client, is that as an independent QA vendor, if I go and talk about give me more and more time and material, it's just doing what they wanted or what the standard set of books which they try to help us, ask us to do. Whereas what we try to do very clearly is that we will take your QA department, we'll try to get that entire project out, we'll be able to bid you at a better cost, so that we'll be bringing efficiency and we can also bring in value. So that is what we have been trying to do. So that definitely fetches me a premium, because when I go in there and when I start doing such thing, for me, the breaking point at any point in time, your question is absolutely valid. That are we going to continuously to do these kind of investments and every quarter and keep looking at negative surprises in terms of trying to ward it over the subsequent quarters? The answer is no, basically, because we have to survive in business and grow, and once we have got one or two referrals at other deals coming through in a big way, I think it's very, very easy for us to really crack through and pick it up. So that is absolutely not essential for me to really give this kind of a surprises and start investing. But I think outcome-based model is what the industry is moving very clearly, even in terms of disclosure business clearly, that and that is lucrative. Why it is lucrative very clearly is that irrespective of the resource cost or whatever it is, that we are at free will basically, because we are tied to the end goal, and we are at free will very clearly to really manage internally in terms of the resources, what we try to do a mix and match clearly. It is not an end resources where each and every resource is interviewed by the client and that is fixed for the project from end to death. So these are the reasons very clearly on the outcome base. So one on outcome base, one is clearly why it really fetches me a margin clearly in terms of efficiency. Two is that the challenge is that it's an interesting business to showcase and demonstrate my strength and confidence. That is what I have my belief in my system. So that is where I'm trying to make the client impress out and start moving out, and which is a win-win clearly. Third point is just coming back to the quarter in terms of what it happened very clearly is that if you ask me anything extra happened, yes, that extra is nothing but very clearly that we have recruited about close to 589 people in line with the business, out of which about 160 people are a replacement cost for me. That has come to 20% higher cost, and we believe that basically as we are revising our rate cards on the parallel, which we believe that this phenomena should end in about a quarter or maximum 4 months time in terms of what the industry with the third wave coming through. We already see attraction. People are trying to settle down and things like that. So that's anybody's guess in terms of the market. But I think, have you baked in these costs in terms of trying to get to the margin? Yes, we have baked in these costs. We have done about 9.4%, 9.5%, say about 10% technically. If you look at it in the last year, we have done it about 16.4% EBITDA, and we have been committing that we will be equivalent or north of that 16.4. For that, the average seems to be at about 17-18% on a gradual basis. It is achievable on the ground very clearly that my efficiency and utilization moving away from 76 to 82, which will come back, which has already come back. I would say that it has already notched about 80% or so in the current quarter, because I already transformed people into billability, and then the newer offerings at a better cost, and these kind of outcome based and inflection of freshers into the system and utilizing my cost. Absolutely, we are very confident that we will be able to really bounce back into these numbers. Of course, there is a variation in business, always plus or minus 2% here and there, but I don't think that's going to be a worry, because we are pulling all our stocks in terms of the cost, and we are very confident that we'll be able to get there. It is not a simple math in terms of trying to just divide the difference and then say that for 3 quarters we are going to be an average of this much, but I think it will be successively moving up clearly, because we just to put it in short very clearly, what we committed in terms of we have not really given any guidance, but what we thought will grow at about 20-22% could be a slightly higher growth rate what we are seeing, but that could neutralize and then get us back to the same margin levels. I hope that
Just one question. In this outcome-based model, just for example, for some reasons we are not able to deliver the benefits to the client as per the contract, then do we have to pay any penalty or something like that? How does it work out?
It is a milestone based. It's a good question basically, because that question doesn't come basically because of the prototypes delivered and verification by the client in terms of client preferences, what is happening around in terms of the background, and then they also have an independent verification with the research analysts like Gartner and Forrester and things like that. What are these clauses in terms? We don't have a penalty clause very clearly in terms of the outcome base very clearly. We have a closure clause basically. We have a 90-day closure clause very clearly, but all these contracts are priced in such a way that 2 contracts what we have signed have got a minimum 1-year commitment term in terms of the deliverables very clearly. The effort spent will be audited and the cost will be reimbursed probably, and that will be subject to audit in terms of based on the deliverables to matching. That is the clause what we have in there.
Okay. And just last question, before I join the queue, are we still confident that in next 4 years we will be able to reach 500 million?
100% both are.
Again, we don't give guidance. So guidance part we don't avoid.
No, like this is what you had earlier guided. So I just wanted to know that whether we are sticking to it, or do you think that the market, the outlook has changed materially? So either you may be able to do more or you may be able to do less. That's about all.
Yeah. So we are absolutely confident that all our plans will materialize, and we are very positive on the next 4 years as we start moving up. Very clear.
Okay. Thank you very much. Wish you all the best. I will join the queue.
Thank you.
Thank you. The next question is from the line of Ritesh Gandhi from Discovery Capital. Please go ahead.
Hi, sir. I just wanted to understand there were a whole host of criteria which impacted our profitability in this quarter. Is there any way in which you can quantify and break up how much of an impact was because of because I mean, a few of these, it's like increase in, people's costs, etc., are actually here to stay, and there are a few which may be exceptional. So how should we be looking at what is the existing run rate? So if you could quantify for us how much of this is exceptional, how much of it is here to stay, and how we expect it to normalize.
We expect, I have given 3 breakups over there, a 3% reduction in EBITDA on account of salary revision and replacement of resources. We are trying to, that will normalize over a period of the next 3 quarters. The new hires made for execution of outcome-based project it's a one-off cost, and it is not going to get repeated out, that 1.5% out over there. And the hires made for Center of Excellence and expenditure will pay it out over the next 3 quarters in terms of the marketing and other initiatives, because these have been front-loaded as against spreading over the 4 quarters, so it just get evened out.
Got it. And then if we have to look at the LTV of effectively the projects which are outcome-based as opposed to time-based, how should we look at it in terms of the returns to us as actually, versus the risks we take in terms of commitment of time?
So yeah, good question. I think there is a normal variance of about anywhere between 15 to 18% more in margins comparing to what a normal margin is on a normal quality assurance contract. That, like for example, we have signed up, probably made baby steps, and we have signed up a huge set of contracts now, and we are moving in that direction. So probably we cannot count this set of margins over immediately that certain percentage of revenue is going to come through in this year on outcome base, and then that's going to jack up my thing. While that will be an added factor very clearly, but I think in terms of the differential, basically it is anywhere between 15 to 18% more. Yeah.
Good. And are we doing this because our clients have asked for it, because the industry is doing it, or this is an initiative which we feel we would like to put our credibility on the line to earn higher returns if we are able to deliver actually kind of high quality product?
Yeah, the probability more basically, Shrikant raised my hand, probability is that we would like, the latter is what is very important, is that we would like to stamp our credibility is one. The industry also is slowly converting and moving towards that, and there are opportunities, and it's a combination effect. Shrikant, you would like to add something on that?
Sorry, I lost part of the question.
No, he was asking about outcome based. Is it the industry demand, or we are stamping our credibility, or
yeah, like you mentioned, it is both. It is both. Yes, yeah, it is both.
Good. And just the last question is that it's, occasionally, when we ask people in the industry, some people view the testing angle as being slightly commoditized and being already offered by the SIs as part of their overall package. How should we be looking at that? And overall, are there any industry studies to show the growth rate of the independent testing industry and the market?
Yeah, see, again, we've been winning consistently against very large SIs, even though they've been offering consolidated services. That is one. And secondly, our focus is now on digital assurance, not just quality assurance. We moved away from quality assurance to quality engineering. Now we're talking about digital assurance. So the growth rates are much higher than the traditional growth rates.
And also, how much would this be industry which we're playing in? How much, in your estimate, would it be? Would be the growth rates of that industry, of the markets where we are playing?
So, at a point, Shrikant. Yeah, please go ahead, Shrikant.
Yeah. Oh, go ahead, Krishna.
Yeah. No, I can add a point here basically that to answer your question in terms of the software testing as a market, basically there are two types of testing. What we're trying to look at is that traditional testing and specialized testing, what we call it as specialized, is done by the independent player. While the growth rate over there has been at about 7%, the traditional testing in terms of vendors who do a SI role is slightly coming down as more and more focused people are trying to look at it on specialized testing. These are not my words. These are from, I can share certain research reports in terms of what the Gardner, Forrester, everything says. Having said that, basically there are the industry out there is there at about 22 billion or so, and which is likely to move up to about close to 40 billion in terms of over the next 5-6 years. I think what we're doing is only a very minuscule scratch in terms of what we're trying to pick up. So there is a good amount of growth. It's only the quality and the differentiation which is very important for us and what we do. Having said that, the bigger SIs, if you look at another top 4-5 people, contribute about close to 12 billion in terms of the industry, in terms of the testing per se. So packaging, when the market talks about packaging could be a possibility basically, but still testing remains an independent part. And we have been witnessing very clearly wherever people have taken a bundled software development and testing together, the testing portion being separated, and we have been winning from global 2000 clients on a very systematic basis. That has been our pitch to really replace and get out separately. So that market is out there and and to grow. And adding to Shrikant, what he said very clearly is that while the quality assurance and engineering space remains at a growth, I think showing the differentiation in terms of trying to get into a digital assurance player and trying to do an outcome based with a value addition, I think there is enormous potential. So we don't see any depth at all. Deficiency.
All right. Thank you so much. I'll just join back the queue. Thank you.
Thank you. The next question is from the line of Surji Karaugi from Smith Capital. Please go ahead.
Hello. Hello, am I audible?
Yeah, very much. Please go ahead, madam.
Okay. Sir, I have just one question. That is, the employee expense and other expenses have increased significantly this quarter. So can you just elaborate the reason behind this?
Yeah, the employee expenses have increased where I've explained in my opening remarks itself is that on account of salary revision at an average of about 10.5% of the total cost to the company, which was originally explained, spread over two by half yearly portion for the need of the market which has been done. Second is that we have done some new hires in terms of the investments and also we have 1-2 new projects which was necessitated as an investment to do about close to 122 people in terms of trying to do a knowledge transfer, and that necessitated as an investment as one thing. And we have also done a leadership hiring in sales and marketing and non-billable managers as a part of our growth and transformation strategy. That is one thing. On the other expenses, if you look at it clearly, the differentiation is that to jumpstart the project and to refill the replacement cost very clearly, we have gone for contract hire of about close to 98 people. That contributed about 7 crores dent to their expenditure, and then the 2 crores differentiation is on account of the marketing spend which is front loaded.
Okay, sir. Thank you. That was quite helpful.
Yeah. Thank you.
Thank you. The next question is from the line of Nagraj Chandrasekhar from Laburnum Capital. Please go ahead.
Hi, thank you. Just in a typical sort of DevOps engagement, a 6 to 12 month engagement, how large is the testing component of the total order value typically for an SI?
Srikanth would like to go.
Can you louder, please? You asked in DevOps engagement, how long is the testing component?
How large is the testing component if you were to unbundle it out of the total engagement typically?
It's maybe 25%.
Okay, sorry.
I mean, it really depends on the kind of project, but just to very simplistically tell you, maybe 25%, 20 to 25%.
Got it. And then when we say we are doing quality assurance, including things like RPA and testing, do we have partnerships with the likes of UiPath or Blue Prism or others?
Yes, we do. We do with UiPath, Blue Prism, Automation Anywhere, Mintex, and one more company which I will recall. Yeah, we do have, yes.
So when we use their platforms, the client is not aware of what is basically used. It's sort of their products are used to automate certain testing methods to the client, and then their testing costs are brought down by us quoting a lower outcome-based fee versus what they were doing earlier themselves. The client is sort of not aware of what is being used by you guys.
No, not necessarily they are aware. In fact, some of the licenses are procured by the clients. We already have them. It is the execution piece that we help them.
Correct.
Sometimes even the licenses, we may be able to procure at a better cost than the client themselves, where we come in. But clients are aware of what we are using. It's not like we are white labeling the products and doing them.
Yeah. So what?
Sorry.
Yeah, what Srikanth is trying to tell, just for the audibility sake, I'm just repeating that, is that all our contracts are transparent contracts, well written very clearly. The client is aware in terms of what the licenses and where we have partnered with and what is going to come them. We insist most of the time the clients to buy the licenses, but we negotiate at a better cost because of the leverage partnership relationship. However, wherever there are cases where we need to do a little bit of investment in terms of the licenses, we don't go back. It is already priced in the contract, and then we try to go ahead and take it up. But everything is transparent. The client is well aware of as to what it is. So we provide services around it. We use that. We don't really camouflage or do any white labeling on that.
Correct. And just the other growth aspects within quality assurance, in your slide you talked about cloud assurance and IoT assurance. How large are these markets, and typically what is the scope of work? Don't digital transformation SIs get this as a scope of work along with their engagement, or is that in this particular cases there is less bundling because it's probably very mission critical for a customer?
Sorry, I couldn't fully understand the question.
How large are these cloud assurance and IoT assurance markets? And typically, what is the scope of work? And is there less bundling here than in typical SI engagements, so that you have a better right to win?
So these are large markets for sure. They are really large. I can't quantify the numbers on top of my mind, but they're really large, which is one of the reasons we picked these areas. The bundling here, it is not very different from our typical DevOps projects. We don't see a lot of difference, at least until this point. We don't have, we have not seen a lot of difference. Maybe we don't have enough data to tell you that the bundling is different here. But up until this point, we have not seen it to be very different from what it is today. In fact, we already have a few projects running from the past, and it is not really different from what we've seen.
All right, thank you.
Thank you. The next question is from the line of Ganesh Mistry from Investor First Advisors. Please go ahead.
Hello, good evening, gentlemen, and thank you for taking the time out to talk to us. And at the outset, congratulations for bringing in 28 new clients and a lot more in terms of deal flows. I just had a few questions, and one was, if you were to just segregate your results from consolidated and standalone, it's evident that we've kind of hired a lot of employees in standalone, which I reckon is in India. So, our standalone employee cost has gone up by about 50% year over year, approximately. The question is that I know you touched upon with the other caller that essentially it will take out 2-3 quarters to kind of run these costs down. But when we say that we have recognized these costs upfront, are we saying that we have recognized it in the P&L and going forward it will be a cash flow impact, or will we see the same 74 crore number in the next few quarters? That's my first question. Then I'll just come to the other.
Okay. To answer the question, probably in terms of the cost which is committed, these are costs which have been committed. I will only be able to translate this in terms of the top line, in terms of the revenue, while I will be optimizing few of the investments what I have made in a rush to see, because anywhere there will be a variance of 2-3%. That 2-3% will be a continuous monitoring in terms of trying to remove the bad apples. But to look at it in terms of the cost as to what we have committed and spent there, we will translate that in terms of the revenue going out very clearly. And to hit it straight very clearly, whether we will reduce this 74 crores back to 50 crores or 60 crores or 65 crores, I think that's not the way we are looking at it. We are looking at very clearly in terms of translation to the revenue, because it is also one more in terms of on a comparable, we have changed. I've highlighted also is that this additional point is that we have changed the if you look at it on the profitability point, you're talking from the cost perspective, I answered your question. But if you look at it from the profitability point on the standalone, we changed the transfer pricing methodology very clearly, and that is going to stand benefited having on the cash flow perspective more cash flow in India. If you look at it in the moving quarters, as my EBITDA starts moving, overall consolidated EBITDA starts moving to about 11%, because I have moved away from a cost plus method and I have gone into a distributed method in terms of the revenue markup method, in terms of retaining revenue markup in the respective regions and complying with the TV provisions over there. So while your expenditure could be remaining same, our revenue will be more, because I expect the overseas expenditure to be optimized, and I will have more money coming in, so that the net result is that it will have an impact in terms of the profitability, and also the cash flow will be high. And I hope to have answered.
Yes, you have. And just one question, sir, also, is that if you were to see, you mentioned that we've hired, I think, about 500 odd employees, of which 589 people, of which 160 were replacement. So I, and I reckon that the other 420 would be new additions to our, stable, which is pretty strong, because essentially if you're looking at 3,100 employees, we have essentially added around 14 to 15% of our employee base in the last quarter. So, do we see that kind of strength in the business, because that's what it's showing, at least to us investors sitting on the outside? And number two is that when do you think that these employees would be gainfully and productively employed? So it kind of fits into your revenue and growth.
Absolutely. Great. Good question. I think from my budgeted number for Q1 of about 30 to 33 million, I moved to 36 million, roughly about 4 million, moving away from last quarter 32 million to just 36 million. Essentially, definitely, yes, out of the 400 odd people, I think I have engaged the people. To be very precise, to answer your question, about 123 people are the one which has been invested and which has started into availability from June 10th to July 10th to July 20th. They have moved out into the availability very clearly. And another 60 people which we have been kept as investment out are in a phased manner in different set of projects. So basically, I have already knocked off around close to 25 people into billing. The balance 35 is translating on 35-40 people are translating on 1st August. So invariably, I'm in a good healthy wicket in terms of improving my utilization from 76 to 82 in terms of the offshore utilization. So very clear that I have a good leg room, and I have got planned clearly. While this is still a linear business, the addition looks substantial. I think in an accelerated growth momentum what we are getting in, it was necessitated for us to really take it up. While the non-linearity may come at the end of the 4th year, But as it stands, I think about 3% is only non-linear of the total revenue. So invariably, I think this linearity is there to move on. Having said that, is it something which is going to affect me on the infrastructure and other costs? Probably yes, on the IT infrastructure, which gets depreciated in terms of the laptops, but not on any other infrastructure. Basically, with working from home, still not started up. Even when it is starting, I think we'll be commencing with 25%, 50% over a period of 2 years. So invariably, it's the same space. And in fact, we have renegotiated the entire lease date to bring in a substantial amount of saving, about $1 million over the next 3 years in terms of what it is on the infrastructure cost. So we are conscious of the fact in terms of the numbers. You are absolutely right in terms of the numbers. We are also confident that all these translations are happening. So we are optimistic.
Got it, sir. And sir, so this 76%, we have our offshore utilization at 76 versus last quarter 81. As you clearly mentioned, it's because of the new employees that we have added. So when do you think we will go back to the 80% plus utilization?
I just made my statement very clearly that I'm already moved into the 80s.
Okay.
I think,
sorry. I may have missed that. Sir.
No, not at all. No, sir. I can repeat it.
Haji.
We are already there in the 80s, and we should be moving towards the end of the quarter to the upward percentile, basically. Yeah.
Fair enough, sir. Fair enough. And I know you did touch upon a bit on the transfer pricing. So is it just from the cash flow perspective, or is there any other taxation thing that we are planning for this change in the transfer pricing model? Just to understand.
One, being a listed company and listed holding company, I think it's very important basically to hold the cash chest within the holding company. One, it can be a reward to the shareholders. Two, it can be for deployment or whatever it is. Two, also on a perspective in terms of our 5-year transfer pricing assessment, which has been done over there, where the US authorities and the other country authorities feel that the cost plus 17 could be a slightly higher percentage in terms of disallowing, and we getting into audit every year in terms of getting this disallowance made. We thought we did a complete study through EY, and we made it more practical in line with what the other industry peers are doing very clearly in terms of retaining a sales plus methodology in terms of fixed margins over there, so that we can have a predictability on the taxation over there, and then bringing the money out to India. And we have adopted the concessional rate of taxation from the current year, so which makes more life simple, and then try to make the money. So if you look at it, the cash at the corporate level makes me the king to really see that what best can be deployed out clearly. So that is the strategy, and also the compliance becomes more comfortable.
Thank you. I would request Mr. Mistry to rejoin the queue for follow-up questions. We would also request participants to please limit your question to 2 at a time. Should you have a follow-up question, please rejoin the queue. Thank you. The next question is from the line of Piyush Mehta from Capri Global Capital. Please go ahead.
Hi, good evening. Thanks for the opportunity. So my first question is on, in terms of, when we have an internal EBITDA margin target, of course, we've seen a big fall this quarter, but when you look 2 years, 3 years out, what is the minimum that the management is comfortable with in terms of the margins that you're looking for the business over a longer term?
Yeah, if you look at it in terms of the transformation business, what we are trying to do over a 4-year time period, if you look at it, I think we will be, we are targeting, and then we are nothing wrong in committing very clearly that we are optimistic that we should be there along with the industry peers at a higher team plus margin very clearly, while we are not committing any numbers out there.
Right.
Plans out very clearly, or that we will be in par with the industry standards here.
Got it. And if you could tell me, what is the current cash equivalent on books as of this quarter?
Yeah. I can tell you that. And we continue to hold about close to 190 crores in terms of cash and cash equivalents in the book, even after distributing dividend and observing these expenses out very clearly.
190, right?
Yeah, 190.
Okay. And are we looking at any acquisitions actively, or because that has been our strategy to find niche businesses, acquire them, and are there any in the pipeline?
Inorganic strategy has been definitely one of the strategy for us, and we will definitely come to the market out in terms of if something really concretely takes shape clearly. But I think the CEO, the CMD, and myself as a CFO and the CRO, we are evaluating a lot of opportunities. But I think we'll be able to comment on it as and when we get to a stage, and then the board evaluates that, and then we move it to the thing. But yes, as a part of the strategy, it is also a part of the growth strategy over the next 4 years.
Fair enough. Thank you. Thank you so much, and good luck for the future.
Yeah, thank you.
Thank you. The next question is from the line of Dipen Sheikh from Crystal Investment Advisors LLP. Please go ahead.
Hi, and thanks for the opportunity. I hope you can hear me.
Yeah, we could hear you. Thank you. Good evening.
Okay. Hi, good evening, sir. So I can see that you've started moving very, very serious strategic levers as committed in the recent past. Naturally, this is taking a toll on short-term reported numbers, and frankly, that's not a bother. It is a little bit of a slippery path, and you have to tread it carefully. And I will, as an external observer, all I can do is monitor you very closely. You've added more than 550 people this quarter. The fall in utilization is mostly attributable to that. All those dots are joining up. A couple of things that don't join up for me are one, that the growth you achieved in this quarter, and sure, it will change as we move forward in time, is coming mostly from the UK, EU, and rest of the world geographies, and not from your core US geography. Is it just a timing thing, or with respect to a certain client that you're ramping up? Or is it that you are trying your new business development and go to market more aggressively in the geographies where you have lesser at stake? What is the color here? That would be my first question.
Okay. Shrikant, shall I go ahead with the question?
Yes.
Yeah. See, there is a marginal shift in the quarter. If you look at it as a composition in terms of the UK and EU, basically notably being that the last year has been subdued year in terms of be it mining, be it reduction in revenue from that region, which is bouncing back. But as a strategy, if you look at it in terms of our overall scheme of things, the base is also moving up. As we're talking about 120, 123 million as to what it was at about 88% or so, I think there could be a natural slippage in terms of the percentage as the composition starts moving up in terms of close to about 140, 150 million when you're talking. So that room of provisioning has to be provided. But I think the natural condition out over there is that we have definitely had our share of slippery in terms of what it is in the last year, which is now moved back in terms of the clients reverting back, and then we have started winning also. One, in terms of having said that, in terms of the focus, if you look at it, I think we have been successful over the last quarter, last 2 quarters, especially on the Middle East and the Asia Pac region as well. But we are also conscious in cherry picking as to what it is, because it's not dent our margins, because the general tendency over there is slightly less. But I think as we see the traction out, we still expect our balance to be in such a way that we'll be at about 85% coming up from the US and other region, which is a bigger market, and which is also comparatively easy to navigate market for me as against the other markets.
Okay. And my second question.
Large clients that we signed, the 2 large clients that we signed that I mentioned earlier are both from US. So that will definitely skew the numbers toward US possibly next quarter.
Yeah, I think as investors, we just need to look beyond quarterly fluctuations. I think that's the lesson for me on this one.
Absolutely right. I agree with you. You're absolutely right in the overall scheme of things. Yes, nothing wrong in me really to move ahead and expand the UK and European region, keeping in mind the entire regulatory aspects and the cost aspects very clearly. Yeah, I think we are conscious of the fact basically, but 1 quarter could be a blip, but I think in the overall scheme of things still will remain balanced out at about 85 to 100 in terms of where we are.
Yeah. The second bit is a little bit of discomfort on the outcome-based approach and the contracts under this, regime of approach that we are taking up. Are you sure that you are implying that some of the EBITDA drop is because of revenues coming in from these contracts where the revenue booking would be back-ended? Is that one of the reasons for the EBITDA margin fall?
To answer your question, probably we have just taken a baby step in terms of trying to win one. The purpose of winning the deal is basically to prove a point very clearly, yes, that we'll be able to deliver that. Two is that we are trying to compete with the bigger SIs and try to take the existing and also the expansion of the business by way of an RFP. So what it necessitated very clearly is that if one is a 36-month contract, one is a 24-month contract, and while moving ahead with those set of numbers very clearly when we have to take it up and when we have started pushing through, sometimes it calls for certain investments. Yes, that is what is the discomfort factor, is that where we need to do the KT to demonstrate out very clearly that the differentiation is that I will invest and I will do the KT and then I will start delivering the entire set of numbers for you. So sometimes it's a business decision which has to be taken really to demonstrate and start moving up very clearly. And considering the logo, considering the volume of business which is going to come up and which can be mined, I think it's a calculated risk which has been taken very clearly. But otherwise, there is nothing to do, because normally these type of contracts, if it is a 36-month contract, normally the revenues as per AS 115 are accrued over a period of 36 months. But the KT is something which has not been really allowed out basically, because the commencement starts of the work post KT. So this is an element which needs to. We have started learning in terms of our effort estimates, so that we are trying to price in these things as we start moving into the contract. But otherwise, in terms of the deliverables of the contract and the quality of the contract, it has got a much, much higher notch comparing to what we are trying to do out on a routine quality assurance business.
Okay, so just for clarity's sake, we've done about $36 million revenue at a console level in this quarter. Right now, the outcome-based contract revenues, have they started flowing into this 36 million, or is it a while away?
The 36 million, right now the entire outcome-based contract is commencing only from July.
Right. So some of the reason why your EBITDA margins are depressed this quarter, apart from the other reasons such as upfronted, business development or manpower spend, is also a little bit of upfront spend on these contracts, which are going to be very lucrative in the future.
I have quantified that and provided that. Absolutely.
Yes, absolutely. Okay, so I'm reading you loud and clear. Thanks very much for the clarity, sir. Thank you.
Thank you.
Thank you. The next question is from the line of Shweta Jain from ANS Wealth. Please go ahead.
Hi, sir. Thank you for giving this opportunity. So my first question is if you could share some details about the 28 new clients that we've added. Typically, what industry do they cater to? What kind of work are we going to do for them? And what type of contract, are these? If you could share some details around it, like the value, is it like a one-time contract? And also, I just wanted to understand typically what happens, with our clients, like the contract that we get, are those contracts renewable, or it's just, like a delivery-based kind of a contract?
Okay, good question basically. I think about Shrikant, I'll just take it on the numbers probably. I'll just take your support in terms of the technicalities, what is needed out very clearly. Thank you. Shweta, just to answer your question very clearly, is that these 28 clients, what we have brought in, includes the 2 clients which has been signed at a TCV, total contract value of 14 million. In terms of the rest of the client, as against the balance 26 clients, I think the TCV has been ranging anywhere about 9.6 million or 9.7 million, if my number is right, in terms of getting it. To answer your question in terms of what is the vertical which has come through predominantly, if you look at it, it spreads over. I don't have exactly to quantify this entire 28, but I think predominantly the new have come from the BFSI and the retail sector. And these are the 2 areas which has been we have been gung-ho about in terms of trying to win, and these have come through a lot of other cross-selling and references. These 2 are the major area. And the healthcare is a few clients have moved in from the healthcare side. So this just as a combination. If you have to cherry pick and tell in terms of a percentile, which may be varying slightly, probably 10% from out of these 28 clients is from. In terms of number of clients I'm talking about, could be from the healthcare side, and the predominantly about 60-65% is from the retail, and the rest on the BFSI as a segment. But coming back to your question in terms of what is that? I'm just trying to retrack. One is that in terms of the number of clients, in terms of services lines where it has come, and pardon me if you can.
The kind of services that we do are around automation. We are doing RPA. One of the clients that we landed has a significant portion of RPA. We hope that will grow into a large RPA account for us in the coming years. But automation predominantly, and for healthcare companies, the kind of testing, the kind of work we are doing is around medical device testing.
Okay.
Yeah. And then typically, sorry, go ahead.
Yeah, in terms of duration, probably just a supplement. We take the contract duration range anywhere between 6 months to 18 months. We invariably set a benchmark in terms of trying to look at it as a 6-month contract. To answer your question in terms of these are one-off type contract or is it a renewable one? Basically, we sign an MSA for 3 years, and within that there are different SOW. Just to quantify for comfort in terms of where we are, around the 40% of our business gets renewed automatically year over year, and these are the contracts which come over year in terms of the 40% of the total revenue which is coming there. And we are trying to steadily improve that out while we balance it out with the rest of the clients. While having said that, the rest of the clients also has huge potential in terms of trying to get through with a set of mining based on the IT budgets what they have. Clearly, we discuss that out and we start trying to look at pitching in terms of mining for the set of clients. Shrikant, would you like to add something?
No, that's what I also wanted to say. Yeah.
Okay. So just one clarification. When we say 40% of our business gets renewed year and over year, so what typically is the nature of the renewal business? I mean, what typically we do, on that side, sir? Is it like continuous testing or continuous updation that we do for them?
Yeah, along with quality engineering work that we do. But right now, what we're trying to do is we're trying to maximize the potential of each account. So that is where the hunting farming model that we have implemented will come into play. And what more can we do to maximize digital opportunities in these accounts? What else can we do to become a digital assurance partner for these companies is what we try and do.
Yeah.
If you just take quality engineering, we cover aspects of functional, automation, performance, security, testing, etc., mobile. But if we want to do more than that, then we look at areas around RPA, then cloud assurance, and so on.
Okay.
And
so basically, we try to. Yeah. Sorry, sir. Go ahead.
Supplementing what Shrikant said very clearly, the renewals come from these large conglomerates which have got huge projects running, so it will be a continuous testing when it gets renewed. If you just map it up to the renewals, basically these are continuous testing. And the projects also has its expansion and new projects coming in very clearly. So that is what it happens typically. Yeah, please go ahead with your question.
So basically, testing and some kind of cross-selling in our own field that we try to get this business with the same client, right?
Correct.
Is my understanding correct? Okay.
Yes.
Okay. Thank you, sir. That was just my question, so it helps a lot. Thank you so much.
Thank you. Ladies and gentlemen, due to time constraints, that was the last question. I now hand the conference over to Mr. Shrikant Chakilam for closing comments.
Thank you everyone for your time. We will certainly circle back with some of the observations and then see you all next quarter for the next earnings call. Thank you. Thank you.
Thank you. On behalf of Cigniti Technologies Limited, that concludes this conference. Thank you for joining us, and you may now disconnect your lines.